I recently stumbled upon an interesting statistic that has changed my views on the market. You probably already know this, right? This is Bitcoin with the average cost basis in the market. How much is the market currently in profit or in losses? The average Bitcoin holder has bought Bitcoin for $56,396. So on average, people are in profit, and historically it was always the best time to buy when the average Bitcoin investor was in losses. So there is a potential to fall much further in the worst case. So far, so good. You probably know about this already. But here's something you probably don't know. This is the number of Bitcoin that is currently in loss. And that's surprisingly high. In other words, there are a few Bitcoin that are multiple X in profit, and there are many Bitcoin that are slightly in losses. If we just look at the number of Bitcoin that are currently in profit versus in losses, that number is much higher than I first thought. The number is currently close to 7 million, and there is close to 20 million of Bitcoin circulating. So at the peak of a bear market, when it was the best time to buy, that was when roughly half of the Bitcoin was in losses, right? 10 million were in losses when 20 million are floating. That's when things turn around. I did not expect that we are already at close to 7 million BTC in losses after we've only dropped slightly in the Bitcoin price, right? This isn't really any big drop at all. We are not yet at the extreme turnaround points, but we're definitely much higher than I'd expected after a rather modest price decline. Have a look at the realized cap net position change. This shows us if people are currently realizing losses in aggregate or realizing gains. And of course, if we rally very quickly in the Bitcoin price, a lot of profit realization occurs. We've seen even more profit realization when we went to 100K. And the 125K peak, while we did see profit taking, wasn't as aggressive compared to the 100K peak. Currently, people are still realizing gains. That's mainly the long-term holders, because the short-term holders are already in losses, but this might flip quite quickly. Really, it's the long-term holders that are to blame for the price correction, for the start of this bear market. Not necessarily the ETFs. What we see here is the ETF position change. So yes, we do see outflows from the exchange traded funds, but the long-term holders, they have much more of a price impact. Just have a look at how this compares to the ETF flows. So the long-term holders, they started selling already once Bitcoin hit 110K, and they accelerated their selling. And the long-term holders are not yet realizing losses. The market in aggregate might very soon, but as long as the active long-term holders are still in profit, they might continue taking that profit. And that's why I'm still short-term bearish. That's why you see the name change of my channel, including the profile picture change. If the reason for this price decline is really the long-term holders selling, and we do not see that metric turning around at any point, why would we assume that the price will suddenly turn around? Who's going to buy that much supply? Now, the long-term holder realized price is of course much lower than the overall market's realized price. It's currently at $36,000. And maybe we go all the way down there. If this is also supported by traditional finance, if maybe AI stocks are about to sell off, then we could go all the way down here. But maybe we turn around a bit earlier as well, because this here includes all the long-term holders. By the way, if you so far enjoy this content and you don't want to miss future videos, then feel free to subscribe. I publish videos regularly over here. Not just the long-term holders that are actively trading. And the actively trading long-term holders, they might already stop selling once they are not realizing profit anymore. It was a quite interesting development that started on the 10th of October of this year. This is when we had the flash crash in the altcoin market, right? The altcoins, they on average dropped by 60% in the matter of 1 hour to then very quickly recover again. But what this massive wick in the price meant is that many people that were betting on rising prices with derivatives, with virtual futures, or people that used stop losses, they lost their funds. And that short-term trading capital is not coming back. Here is the open interest on the perpetual futures. It crashed on the 10th of October, and since then continues to go down. And that's an overall deleveraging event that pushes down crypto prices with it. So it's not just the long-term holders that are taking profit, it's also the short-term traders that used leverage, that still might have some capital left, but that are now not confident anymore to continue with their trading after they've lost already that much, right? Not everybody has 100% long positions open. Maybe some of those traders had longs and shorts open. The long side got completely wiped out, and the remaining capital that was short is now getting withdrawn from the exchanges. And that then, of course, this deleveraging will, via arbitrage bots, also have an impact on the spot prices. And there is correlation between altcoin flows and the Bitcoin price as well. Have a look at Hyperliquid, right? This is the largest decentralized exchange for levered bets for perpetual futures. The 10th of October was a real turnaround point. Since then, we see capital outflows. The funding rates are also not as positive anymore, again, because short-term traders on the long side got wiped out. What I find fascinating is that this massive flash crash on the 10th of October, it was positive on that day for many market makers, for Hyperliquid itself as well, right? This is the market maker of Hyperliquid. It made 40 million of profit in a single day, and it took 1.5 years to make the first 80 million. So this was positive, but since that flash crash, in the recent past, we don't see any more profit making. The past month IPR was 0, and this tended to be at around 10%. Now, my impression is that some of the market makers might have gone completely out of business, and maybe we haven't yet seen any kind of knock-on effects. Maybe some of the funds, they might have gone belly up and we haven't just gotten that announcement yet. We got something very similar during the Terra Luna collapse, right? First, it was Terra Luna with the USD stablecoin that went belly up. And then afterwards, we saw Three Arrows Capital, etc. and FTX that imploded as a follow-up from Terra Luna. And maybe the 10th of October created more damage than is now visible to most. And maybe some entities getting out of business and selling their remaining stock is the reason for this continuous negative trend, which of course gets supported by the long-term holders selling off, which in theory could be the exact same thing, right? It could be market makers that suddenly liquidate their last remaining assets. A lot of the supply is already in loss, much more than I expected. Still, I continue to stay bearish, at least until we hit the 56K, the average cost basis of the market. But that's not necessarily a bad thing, right? We can make money in either direction. Most people just make money in bull markets, but I actually think it's harder to make money in bull markets than in bear markets, because most altcoins tend to underperform Bitcoin and Ethereum most of the time. So if we bet on falling altcoin prices during a market phase like this, we tend to make money relatively consistently. Now, this whole game can be as complex or as simple as we want. We can just dollar cost average into the market, just bet on long-term adoption, bet on long-term devaluation of money, and we are fine. We don't necessarily have to time the market. Alternatively, we can make it very complex, as in we try to follow every single piece of news. We try to get an edge by being more informed than the average market participant. I think the best is a middle ground, trying to still time the market, but not just based on guesswork, based on mathematical approaches that used to work pretty well in the past. And so this is my favorite approach. It's following a technical indicator, the moving average, that historically worked the best. What we see over here, that's the 44-day simple moving average. And the strategy is very straightforward. We go long, we bet on rising prices whenever we are above that moving average, and we bet on falling prices whenever we are below that moving average. Now, I've backtested all moving averages from the 2-day to the 200-day, and the 44-day is one of the best. And historically, this worked very well. Will it work in the future? Who knows? But at least over the last 10 years, it performed much better compared to just buying and holding. Buying and holding is the line here in white. Every horizontal line here, by the way, that's a 10x return. So this performance is more than 100x better than just buying and holding Bitcoin. Here's the same performance measured in BTC. And so that's then the potential alternative to just dollar cost averaging into Bitcoin, trying to ride the market. Now you can simply trade this yourself, right? You can just buy and sell whenever you're above or below the 44-day simple moving average, Or if you wanted to, you can also allocate towards that strategy directly. So that's part of the premium membership of this channel. The link is down below. It's thebitcoinstrader.com. A link to premium pops up here on the screen. It will lead you to the website. Thanks again for watching and see you next time. Cheers.